Hello everyone, welcome back to another exercise tutorial from chapter 10 exercise series of our managerial accounting course, ACCT 4 to 8. In this video we're going to be looking at exercise 10-9A. So let's read the question together. It says, Gertie Manufacturing Company has an opportunity to purchase some technologically advanced equipment that will reduce the company's cash outflow for operating expenses by $640,000 per year. The cost of the equipment is $3,932,522 $0.88. Very specific number. Gertie expects it to have a 10-year useful life. Let's highlight this because it's really important. Okay. And a zero salvage value. The company has established an investment opportunity hurdle rate of 9%, okay, and uses a straight line method for depreciation, right? What's required here in rounding your computations to 2 decimal places? A, calculate the internal rate of return of the investment opportunity, okay? Now, how can we do this? We can do this if we have the present value interest factor table, specifically table 2, the present value interest factor of annuity, because as the situation is explained in the question, this is going to be over 10 years, right? We can simply do it by reverse engineering our formula. Right? So let me quickly remind you of our formula first, and then we'll see how we can use it. So the present value of annuity, okay, is equal to the payments multiplied by the present value interest factor of annuity, right? Which is presented in table 2. Now, if we know that our life of the investment is expected to be 10 years, right? We don't really know the rate of return. So this is what we are trying to find, which is R right here. Okay? So if we know the present value of the annuity, and we know the PMT, and we can refer to the table to find the factor that will make this formula hold true. Okay? Let me substitute first, and then hopefully you'll understand what I'm saying. So what is unknown here is this portion, right? And it's only unknown because we don't know the rate of return. We know it's for 10 years, or the life of the investment, the expected life of the investment is going to be 10 years, but we don't know the rate of return, right? But we know the payment, or the annuity amount, and we know the present value of the annuity. Okay, so let's substitute here. Going back right here, this is the payment. Okay, $640,000 per year, and the present value of the annuity is given to us right here, this very specific number that we have read in the question. So I'm going to substitute $3,932,522.88 should equal $640,000 multiplied by the present value interest factor of annuity for 10 years and an unknown rate of return. Okay? Now I can simply reorganize this, right, by taking this right here to this side and put it in the denominator, right? Mathematically, I can do this. So I'm going to rewrite my formula as follows. $3,932,522.88 divided by $640,000 should equal my present value interest factor of annuity for 10 years with the rate of return unknown. So I'm going to run the numbers on my calculator first. 3,932,522.88 divided by 640,000. Okay, that's going to give us that the present value interest factor of annuity for 10 years and R unknown equals 6.144567. Okay, now that I have this, I can simply go to my table 2, the present value of annuity table, and look for this in correspondence with the 10-year line. Okay, so the number we're looking for is 6.144567. So let's go to the table 2 right here and look for the 10-year period. Okay, and then move across this way until we find our number. It's 6.144 right here. I'm just double checking on my calculator if it's exactly the same. 6.144567. Yes, it is correct. So that means this is the rate of return that we're looking for. This is going to be our internal rate of return. All right. So from this, we could say, looking for $6.1446 in table 2 at n equals 10 years provides that rate of return equals 10%, which represents the internal rate of return for this investment. Okay, that's it. So that is the answer to part A. Now let's see what is required in part B. It says indicate whether the investment opportunity should be accepted. Now, to determine whether this should be accepted or not, we need to refer back to the question and notice that in the last line or the last sentence in the question, it says the company has established an investment opportunity hurdle rate of 9%. Okay? And if you remember our discussion, excuse me, if you remember from our discussion in class, that the hurdle rate basically means that this is the crossover point that the company determines whether, or use to determine whether they should accept an investment opportunity or not. Okay, usually this is the weighted average cost of capital, as we have discussed in the lecture, right? So knowing this, we need to compare the rate of return the internal rate of return that we have determined with this hurdle rate. If the internal rate of return is greater than the hurdle rate, then we should accept, or the company should accept the investment opportunity. If it's lower than the hurdle rate, then they should reject. Okay? So for this, we're simply going to say the internal rate of return, which is 10% in this case, is greater than the hurdle rate, which is 9%. Thus, the investments should be accepted. All right. That's it. It's an easy, relatively easy question, but you need to know this shortcut method of finding the internal rate of return, right? Otherwise, the internal rate of return has a complex calculation, but since we can use this shortcut to find the internal rate of return, why not? Okay. Once you find the internal rate of return, you can simply just compare it to the hurdle rate that is given to you in the question and see. If it's greater than the hurdle rate, then you accept the investment. If it's smaller, of course, then you reject. Okay. Hope that you found this video useful. If you have any questions, please leave them down in the comments. Until I see you in another exercise video, please take care.